Hey everyone, welcome back to Wealth for You, where we break down finance and investing in plain English. Today we're diving into the first quarter of 2025 results of UOB, one of Singapore's big three banks. Now listen, with all the global uncertainty going on, you'd expect banks to struggle, right? But UOB? It's holding up like a champ. While markets are shaky, UOB just posted strong profits, a solid 7.1% dividend yield, and remains one of the most stable banks in the region. And I'm going to show you why it's still one of the best dividend stocks for Singapore investors, especially if you care about income and long-term growth. So stick around till the end. We're breaking down all the key numbers like PE ratio, dividend yield, capital strength, and whether UOB is still a good buy. And if you want more clear, no-nonsense investing breakdowns like this, smash that like button, hit subscribe, and join us here at Wealth for You. Disclaimer: this video is for educational and informational purposes only and is not financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. Section 1. UOB First Quarter FY25 Results. UOB reported a net profit of $1.49 billion in the first quarter of 2025. That's almost the same as last year, just a tiny 0.3% increase, and down 2.1% compared to the previous quarter. The slight dip was due to a higher tax rate under the new international tax rules, not because the bank's business is weak. Here's what went well. Net interest income was $2.41 billion, up 2% year-on-year thanks to strong loan growth of 5.7%. Fee income hit $694 million, up nearly 20%, mostly from credit card spending, wealth management, and loan-related fees. Other income from treasury and trading activities also bounced back strongly, rising 25% quarter-on-quarter. And even though the bank set aside more money as a cushion for bad loans, what they call credit costs at 35 basis points, they emphasize there's no systemic risk, and that's just a precaution in a shaky global economy. Section 2. Why UOB is still strong. So the big question, is UOB still a strong stock to invest in? Absolutely. Here's why. 1. Strong balance sheet. CET1 ratio, 15.5%. This is the bank's core capital buffer. Higher equals safer. Liquidity coverage, ratio, 143%, meaning they have plenty of cash to cover short-term needs. 2. Resilient income. Even with economic uncertainty, UOB managed to grow income across loans, fees, and treasury, a sign of diversified revenue streams. 3. Capital returns. UOB is still committed to a $3 billion capital distribution plan, including a special dividend of 50 cents and $2 billion in share buybacks over the next 3 years. Section 3. Key investment metrics. Now let's break down the numbers that matter to us as investors. The metrics that tell us whether UOB is truly worth buying. As of May 7th, UOB's share price is $34 plus. But analysts have a consensus target price of $38 plus, which means there's still upside potential if the bank continues to deliver steady results. Next, take a look at the PE ratio. It's around 9.36 times forward earnings. In simple terms, you're paying $9 for every dollar of expected profit. For a strong dividend-paying bank, that's considered reasonable. Now consider the price-to-book ratio. It's sitting at 1.13 times. That's below historical averages, and it means the stock isn't overvalued based on the bank's actual assets. But the best part for income investors? UOB is offering a projected dividend yield of 7.1% for 2025. That's really solid, especially when compared to fixed deposits or CPF interest. And don't forget return on equity. At 12.3%, it shows UOB is doing a good job turning shareholder money into profits. So to sum it up, you're paying around 9 times next year's earnings for a bank with strong capital, stable profits, and getting a 7% dividend while you wait. That's a sweet deal, especially in today's low-growth, uncertain environment. Section 4. Outlook. UOB did pause its full-year guidance due to global uncertainty, but here's the good news. ASEAN and China trade flows remain strong. They have a healthy pipeline for infrastructure financing. Fee income and loans are still growing steadily. Unless the global economy takes a huge hit, UOB should meet or exceed most of its targets by year-end. Conclusion. So if you're a Singapore investor looking for reliable dividends to grow your passive income, financial stability in an uncertain world, and long-term exposure to ASEAN's rising economic power, then UOB remains a strong blue-chip stock worth keeping in your portfolio. If you found this video helpful, give it a like. It really helps support the channel. And tell us in the comments, are you buying, holding, or watching UOB right now? Don't forget to hit subscribe and join us here at Wealth for You for more simple, smart investing insights. Until next time, invest smart, stay steady, and take care.